Chapter 1: The Auction Environment. Moving beyond the chart. The blinking cursor of a candlestick chart is a seductive lie. To the uninitiated, it looks like a heart rate monitor for greed and fear, a two-dimensional battlefield where the goal is to guess which way the next line will lean. But if you treat the futures market as a game of pattern recognition, you are fundamentally misinterpreting the machinery. The market is not a random walk, nor is it a visual puzzle to be solved with colorful indicators. It is, in its purest form, a continuous, dual-way auction, a frantic, high-speed negotiation designed to do exactly one thing: facilitate trade and find the price at which the maximum number of contracts can change hands. Success in this environment requires a violent departure from predictive gambling. While the novice stares at a head and shoulders pattern and wonders what will happen next, the mechanic looks at market structure and asks what is happening now. We must stop asking, where is the price going? And start asking, has the auction completed its business at this level? This shift from prediction to observation is where the edge resides. The market is a physical mechanism governed by the laws of supply and demand. And like any machine, its movements are the result of specific inputs. To decode it, we must peel back the skin of the chart and look at the gears beneath. These gears are comprised of three fundamental pillars: structure, volume, and volatility. Structure provides the map, revealing the historical architecture where buyers and sellers have reached equilibrium or reached a point of rejection. Volume acts as the fuel, serving as the ultimate advertisement of conviction. Without it, price movement is merely a hollow rumor. Finally, volatility defines the boundaries of the playing field, dictating the intensity and speed of the auction. When these three elements are aligned, the mechanics of motion become clear. Throughout this book, we will treat the futures market not as a casino, but as a laboratory. We are moving beyond the vanity of the perfect entry and toward a deep, mechanical understanding of why price moves, why it stalls, and why it reverses. By viewing the market as a live auction rather than a static chart, you stop being a victim of the price action and start becoming an observer of the order flow. The goal is no longer to be right about the future, but to be accurate about the present. This is the first step in mastering the mechanics of motion. Chapter 2: The Engine Room: How Futures Markets Function. To understand the futures market, one must first view it not as a chaotic bazaar of flickering numbers, but as a meticulously engineered engine room. Unlike the equity markets, where ownership is the primary goal, the futures market is a theater of obligation. It is a world defined by the contract, a legal promise to buy or sell a specific asset at a predetermined price at a specific point in the future. This structure was originally forged in the mud of grain pits to protect farmers from price collapses and millers from shortages, but it has evolved into the most sophisticated laboratory for price discovery in existence. At its core, the futures market is the financial world's way of quantifying the passage of time and the uncertainty of tomorrow. The primary mechanism that keeps this engine from seizing is the standardization of terms. In the over-the-counter world, two parties might haggle over the quality of crude oil or the exact date of a gold delivery. In the futures market, the exchange removes these variables, dictating everything from tick size and contract value to the specific chemical grade of the underlying commodity. This rigid uniformity is what allows for high-velocity liquidity. Because every participant is trading an identical instrument, the focus shifts entirely away from the logistics of the physical asset and onto the one variable that remains: the price. For the structural analyst, this standardization is a gift, providing a clean, controlled environment where the mechanics of motion can be observed without the friction of idiosyncratic deal terms. Behind the curtain of every trade stands the clearinghouse, the silent arbiter that ensures the integrity of the ecosystem. In a traditional bilateral trade, you are only as safe as your counterparty's word. In the futures landscape, the clearinghouse steps between every buyer and seller, becoming the buyer to every seller and the seller to every buyer. By demanding performance bonds, or margin, and settling accounts to the market price every single day, the clearinghouse effectively eliminates counterparty risk. This creates a zero-sum environment where every dollar gained is a dollar lost by someone else. and where the movements of the market are dictated by the constant shifting of capital and the relentless pressure of margin calls. This logistical framework is what makes futures the ideal canvas for decoding market structure. Because the contracts are finite, marked by birth and expiration, they create a cyclical rhythm of accumulation and distribution. The engine room functions by processing information into price action through the sheer force of forced liquidations and institutional hedging. When we analyze order flow or volume profiles, we aren't just looking at random dots on a screen. We are looking at the visible exhaust of a massive machine designed to move risk from those who cannot afford it to those who believe they can profit from it. Understanding these mechanics is the prerequisite for reading the intent behind the tape. Chapter 3. The players and their motives. Who moves the market? To the untrained eye, the blinking numbers on a trading terminal represent a chaotic storm of random chance. But behind every tick, every flash of green, and every aggressive sweep of the order book, there is a pulse. A deliberate intent driven by a specific archetype of participant. The market is not a monolith. It is a sprawling ecosystem where different species interact, each motivated by a unique set of needs. To decode the mechanics of motion, one must first recognize that price movement is simply the physical expression of these competing agendas clashing in real time. At one end of the spectrum are the hedgers, the commercials, who treat the futures market not as a casino, but as an insurance policy. These are the airlines locking in fuel costs and the Midwestern farmers protecting the value of a harvest that hasn't yet left the soil. They are often indifferent to making a profit on the trade itself. Their objective is the mitigation of real-world risk. Because their positions are usually massive and non-discretionary, they provide the foundational liquidity, the dead weight that anchors the market. When a massive producer enters the fray, they create a gravity well that alters the flow, absorbing the volatility that others seek to exploit. Opposing the hedgers are the speculators, a broad category ranging from the retail trader in a home office to the Tier 1 hedge fund manager in Manhattan. These participants are the market's risk takers, the grease in the gears who provide liquidity in exchange for the opportunity to profit from price fluctuations. While the retail trader often operates on intuition or technical patterns, the institutional speculator operates with a predatory precision, utilizing sophisticated algorithms and deep capital reserves to hunt for inefficiencies. Their motive is singular: extraction. They do not care about the underlying commodity. They care about the delta between where the price is and where it is forced to go. Finally, there are the high-frequency traders, HFTs, the digital ghosts haunting the microstructure of the exchange. Operating in microseconds, these players don't trade based on supply and demand in the traditional sense, but on the math of the flow itself. They are the market's scavengers and architects, providing instantaneous bids and offers while simultaneously front-running the footprints of larger players. When you see the market shimmer with thousands of canceled orders in a single second, you are witnessing the HFTs testing the resolve of other participants. Understanding how these distinct groups, the hedgers, the speculators, and the machines interact is the only way to understand why the market moves the way it does. Chapter 4. The Theory of Auction Market Value. At its core, the futures market is not merely a collection of flickering numbers on a screen. It is a living, breathing mechanism designed to facilitate trade through a constant two-way auction. While the novice trader views price as an absolute truth, the seasoned professional understands that price is merely an advertisement. It is the bait thrown into the water to see if a buyer or seller will bite. The true objective of the market is to find the point where both parties agree on the possibility of a transaction, a state of equilibrium known as value. Like a pendulum seeking its resting point, the market spends its existence swinging between a state of discovery and a state of balance. In this context, value is not a static figure etched in stone. It is a temporary collective agreement. This agreement is visualized through market profile, a tool that organizes price action not by time, but by the distribution of volume and opportunity. When price lingers in a specific range, it signals that the market has found a fair neighborhood where both the bull and the bear are willing to do business. This is the value area, the zone where approximately 70% of the day's activity occurs. Within this zone, the market is efficient, the participants are in consensus, and the mechanics of motion slow to a rhythmic, predictable crawl. However, the auction is never static. The moment new information enters the system, a sudden shift in economic data or a geopolitical tremor, the previous consensus is shattered. The market immediately becomes unfair, and the auction accelerates as it seeks a new level of balance. It breaks away from the old value area, embarking on a vertical search for the next price point that can attract significant volume. This transition from balance to imbalance is the heartbeat of the market. To decode market structure is to recognize when the auction is merely rotating within a known comfort zone and when it is aggressively hunting for a new reality. Understanding this distinction between price and value is the hallmark of a professional mindset. Price is where the trade is occurring at this exact second, but value is where the market wants to be. When the two are aligned, the market is in balance. When price diverges significantly from value, it creates the tension required for the next great move. By learning to read the auction's intent, a trader stops chasing the noise of an erratic price and begins to see the underlying architecture of the auction, moving from a position of uncertainty to a position of informed observation. Chapter 5: Anatomy of the Volume Profile. To the uninitiated, a price chart is a two-dimensional battlefield where time and price engage in a linear struggle. But price alone is a hollow metric. It tells us where the market went, but it remains silent on the conviction behind the move. To truly decode the mechanics of motion, we must introduce the third dimension: volume distributed by price. The volume profile is not merely a technical indicator, but a topographical map of market sentiment. It reveals the footprints of institutions and the scars of previous liquidations, transforming a flat vertical axis into a landscape of peaks and valleys that dictate the path of least resistance. At the heart of this landscape lies the point of control, the single price level where the greatest number of contracts changed hands during a specific period. The POC is the market center of gravity, the ultimate fair value where buyers and sellers found their most harmonious equilibrium. It acts as a powerful magnet, often pulling price back into its orbit when the market loses momentum. Surrounding this point is the value area, typically representing the 70% of total volume where the bulk of the day's business was transacted. Understanding the value area is critical because it defines the acceptance zone. When price escapes this zone, we are witnessing a breakout into price discovery. When it fails to leave, we are observing a market in rotational balance. If the POC is the heart of the profile, the high-volume nodes, HVNs, and low-volume nodes, LVNs, are its skeletal structure. High-volume nodes represent areas of heavy consolidation where the market has spent significant time and energy. These act as buffers, slowing price down as it enters a zone of high agreement. Conversely, low-volume nodes are the voids, the thin areas where price previously sliced through with little resistance because no one was willing to facilitate trade at those levels. These gaps represent rejection and urgency. By learning to read these nodes, you stop guessing where price might pivot and start seeing where the market's internal architecture forces it to stall or accelerate. Chapter 6: Mapping the Terrain, High and Low Volume Nodes. To master the futures market, one must learn to view the price scale not as a vertical ladder of equal rungs, but as a topography formed by the gravity of cumulative interest. This is where the concept of the volume profile transitions from a mere charting tool into a sophisticated map of market psychology. While a standard price chart shows you where the market has been, the volume profile reveals where it has struggled, where it has rested, and where it has sprinted. By identifying high-volume nodes, HVNs, and low-volume nodes, LVNs, we begin to see the difference between a market that is merely drifting and one that is colliding with a structural barrier. The distinction begins with the scope of our lens, the session profile versus the composite profile. A session profile provides the granular detail of a single day's auction, a tactical snapshot of intraday shifts in sentiment. It is, however, the composite profile that provides the strategic lay of the land. By aggregating months or even years of data, the the composite profile filters out the ephemeral noise of daily news cycles to reveal the permanent architecture of the market. These larger distributions serve as the ultimate benchmarks. They are the mountain ranges and canyons that dictate the long-term flow of capital, turning what looks like random volatility into a predictable response to historical value. High-volume nodes represent the market's collective consensus, acting as fair value zones where heavy two-way trade has occurred. These are the plateaus of the price map, characterized by high liquidity and slow movement. When price enters an HVN, the mechanics of motion shift toward friction. Because both buyers and sellers are comfortable trading at these levels, price tends to rotate and churn, often stalling for hours or days. To the untrained eye, this looks like a boring sideways market, but to the decoder of structure, it is the market filling in and solidifying a base. Understanding an HVN is the key to knowing when to expect a slowdown and when to avoid being chopped up by aimless oscillation. In stark contrast, low-volume nodes are the voids, the precipices where the market has historically spent very little time. These gaps represent areas of transition where either the buyer or the seller was in such total control that price discovered new levels almost instantly. If an HVN is a swamp that slows price to a crawl, an LVN is a sheet of ice. When price retests these zones, it tends to accelerate, slipping through the vacuum toward the next area of high liquidity. By mapping these nodes, we stop guessing where price might turn and start predicting where it will likely gain momentum, allowing us to align our trades with the natural physics of the auction. Chapter 7. The Physics of Rejection, Excess and Tails. In the grand laboratory of the futures market, price serves as a relentless probe, constantly testing the boundaries of value to see where the collective will of the participants finally snaps. We often visualize market movement as a fluid stream, but in reality, it behaves more like a physical object encountering a solid wall. This is the phenomenon of excess. The moment when the auction reaches a level so extreme that the opposing force doesn't just meet the current trend, but overwhelms it with violent efficiency. When the market probes a high or low and finds a sudden, aggressive vacuum of buyers or sellers, it creates a tail, a structural footprint that signals the market has traveled too far, too fast. Anatomy of a rejection begins with a surge of confidence that overreaches. Imagine a market rallying with conviction, carving out a vertical path on the profile, only to hit a price point that triggers a massive influx of responsive selling. To the untrained eye, this looks like a peak. To the technician of market structure, it is a moment of price discovery concluding in a buying vacuum. The resulting candle or profile TPO leaves behind a long, thin wick, a tail, representing prices that were explored but deemed utterly unsustainable. This excess is the market's way of slamming the door and locking it, creating a firm boundary that defines the playing field for the sessions to follow. Understanding the physics of rejection requires a shift in perspective. You are not looking for where the market likes to be, but where it refuses to stay. Acceptance is a slow, methodical process of churning volume at a high-density node, but rejection is swift, sparse, and dramatic. When excess is present, it acts as a structural anchor, providing the necessary friction to turn the tide of momentum. Without excess at the extremes, a move is often considered unfinished business, a mechanical weakness that suggests the market will eventually have to return to those levels to truly find the limit. Learning to spot these tails as they form is the difference between catching a falling knife and standing on the firm ground of a confirmed structural reversal. Chapter 8. Identifying Market Context, the Day Type Framework. The market does not move in a vacuum. It breathes through rhythmic cycles of expansion and contraction. To the untrained eye, a single trading session might appear as a chaotic blur of green and red candles, a sequence of random collisions without rhyme or reason. However, when we apply the day type framework, the noise begins to resolve into distinct structural patterns. By identifying the specific architecture of a session early on, we transition from reactive guessing to proactive positioning. We stop asking what the market might do and start recognizing what it is already doing, allowing the prevailing geometry of the day to dictate our tactical approach. Consider the trend day, the purest expression of directional conviction. On these days, the market functions like a high-speed locomotive, driven by a significant imbalance between institutional buyers and sellers. Prices open at one extreme and spend the duration of the session aggressively seeking new value, rarely looking back to fill gaps or test old levels. In this context, the mechanics of motion are simplified into a singular, overwhelming force. For the trader, the challenge is not finding a reversal point, for there are often none, but finding the courage to board the moving train before it leaves the station. Contrast this with the normal day, a term that is frequently misunderstood as uneventful. In reality, a normal day is defined by a massive early surge of activity, often driven by a high-impact news event that establishes a wide range within the first hour of trade. Once this initial boundary is set, the market spends the remainder of the session oscillating within it, unable to find the fuel necessary to break out. Here, the context shifts from momentum to mean reversion. The edges of the initial balance become the defining walls of the arena, and the savvy participant learns to fade the extremes rather than chasing the breakouts that are destined to fail. Finally, we encounter the complex choreography of the neutral day and the frustrating confinement of the non-trend day. The neutral day is a battle of equals, where both buyers and sellers attempt to push the market beyond the opening range, only to be violently shoved back toward the center, resulting in a session that closes near its midpoint. Meanwhile, the non-trend day represents a total lack of institutional participation, a low-volume squeeze where the market's pulse barely registers. By classifying the session into one of these four structural archetypes, we gain the ultimate psychological advantage, the ability to align our expectations with the market's current reality, ensuring we are never caught trying to apply a trend-following map to a range-bound world. Chapter 9. Volume as a Validator. Confirming price action. Price is the narrative, but volume is the conviction. In the chaotic theater of the futures market, price action on its own can be a deceptive protagonist, capable of staging dramatic rallies or gut-wrenching sell-offs on the thinnest of pretenses. Without the context of participation, a move toward new highs is merely a suggestion, a directional probe that lacks the muscle to sustain itself. To truly decode the mechanics of motion, we must look past the height of the candle and scrutinize the vertical volume bars standing at its feet. These bars represent the collective vote of the market participants. They tell us whether the current trend is a well-capitalized expedition or a hollow sprint into a vacuum. The concept of a healthy trend is rooted in the synergy between price discovery and increasing engagement. When a market breaks out of a consolidation zone, we look for a corresponding surge in vertical volume to validate the move. This surge signals that institutional players are putting their chips on the table, confirming that the new price levels are being accepted rather than rejected. In this environment, every uptick is met with aggressive buying, and every downtick is absorbed by eager bidders. This is a market in harmony, where the velocity of the move is backed by the fuel of high participation, creating a self-reinforcing loop that propels the trend toward its logical conclusion. Conversely, some of the most treacherous traps in trading are found in the low-volume pump. This occurs when price drifts upward, not because of overwhelming demand, but because of a temporary absence of sellers. In these scenarios, the tape looks bullish to the untrained eye, but the vertical volume tells a story of apathy and thinning liquidity. These moves are fragile. They are the financial equivalent of building a skyscraper on a foundation of sand. When the first significant seller enters the fray, there is no depth of volume to absorb the impact, leading to a violent reversal as the market seeks a level where two-sided trade actually exists. Mastering the use of volume as a validator requires a shift in perspective. Instead of treating volume as a secondary indicator, we must view it as the vital life force of price action. By contrasting the intent of the price move against the intensity of the volume, we can differentiate between a legitimate breakout and a distribution trap. When price and volume rise in tandem, the trend is robust and worthy of trust. But when price stretches higher while volume begins to wane, the mechanics of motion are breaking down, signaling that the move is exhausted and a correction is not just possible, but inevitable. Chapter 10. Volatility. Decoded, the market's pulse rate. To the untrained eye, volatility is often mistaken for direction, a chaotic flurry of price action that signals danger. But in the mechanics of motion, volatility is not the move itself, it is the heartbeat of the tape. It represents the market's pulse rate, fluctuating between the rhythmic calm of a steady gait and the frantic palpitations of a sprint. Before a trader can master market structure, they must first learn to distinguish between the ghost of the past and the ghost of the future, shrieks of history versus the whispers of expectation. Historical volatility is the rearview mirror of the marketplace. It tells us how much the instrument actually moved, a cold accounting of realized standard deviations over a set window of time. It is a vital metric for understanding a contract's personality, but it is inherently reactive. If we rely solely on what has already happened, we are attempting to navigate a high-speed curve by looking only at the tire tracks behind us. In the futures pits, the past is a guide, but it is rarely a guarantee. It tells us what the market was capable of, not what it is bracing for now. The true shift in a professional's perspective occurs when they transition from historical data to implied volatility. This is the market's collective prophecy, a mathematical extraction of the premium participants are willing to pay for protection. When IV spikes, the market is not just moving, it is breathing faster in anticipation of a shock. This is often termed the fear index, but more practically, it serves as the governor of our trading ranges. It dictates the width of the playing field, expanding the boundaries of what is considered a normal move and forcing us to recalibrate our risk parameters to match the market's heightened state of arousal. Understanding this pulse is what allows a trader to size their positions with mechanical precision. When the pulse is slow and steady, the ranges are narrow and the structure is rigid. When the pulse quickens, the same 20-tick stop-loss that served you yesterday becomes nothing more than noise in a much larger vibration. By decoding these expected moves, we stop fighting the waves and start timing the tide, recognizing that volatility is not an obstacle to be feared, but the very energy that drives the mechanics of price discovery. Chapter 11, The Order Book, Visualizing Liquidity. To understand the mechanics of price movement, one must look past the flickering neon digits of a price chart and into the engine room of the exchange. The Limit Order Book, LOB. If price is the destination, the order book is the terrain through which it must travel. It is a dual-sided architecture of intent, a vertical stadium where the collective willpower of thousands is condensed into two primary columns. On one side, the bids represent a layered floor of support. On the other, the asks form a tiered ceiling of resistance. Together, they create a landscape of liquidity that dictates not just where the market is, but where it is physically capable of going. At the heart of this structure lies the bid-ask spread, the neutral zone where no business is done. This narrow gap is the no man's land of the futures market, a vacuum that exists between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. The spread is more than just a transaction cost. It is a measure of the market's immediate tension. When the spread is tight, the market is a well-oiled machine, fluid and efficient. When it widens, the structure begins to fracture, signaling a lack of consensus and foreshadowing the volatile, jagged movements that occur when liquidity suddenly evaporates. The true architecture of the book, however, is built by the resting orders. These are the limit orders, the walls of capital, waiting at specific price levels to be filled. To the untrained eye, the order book looks like a static list of numbers, but to the decoder, it is a topographical map. Large blocks of resting liquidity act as gravitational anchors, pulling price toward them as they offer a guaranteed exit for aggressive participants. Conversely, when these walls are thick enough, they act as impassable barriers, absorbing the momentum of incoming market orders like a sponge. Understanding the LOB means recognizing that price does not move because it wants to. It moves because it is being funneled through these corridors of liquidity. Visualizing this liquidity is the key to anticipating the market's next breath. Every tick up or down is a micro battle of attrition, where market orders eat through the layers of the limit order book. If a buyer wants to move the price higher, they must physically exhaust every resting sell order at the current offer before the price can migrate to the next level. By decoding the depth of these walls, we can begin to see the path of least resistance. We stop chasing the phantom of price and start tracking the reality of volume, identifying the structural boundaries where the market is likely to stall, pivot, or accelerate into the void. Chapter 12, Market Delta, the force of aggression. To understand the mechanics of motion, one must distinguish between the intent of the patient and the violence of the urgent. While the limit order book represents the potential energy of the market, a vast reservoir of passive liquidity waiting to be filled, it is the market order that acts as the kinetic spark. Market delta is the mathematical expression of this urgency. It is the net difference between the volume transacted at the offer and the volume transacted at the bid. In simpler terms, delta is the footprint of aggression. It measures which side of the trade was willing to pay up or sell down to ensure immediate execution, effectively crossing the spread to force a change in state. Every tick in the futures market is a localized struggle for territory. When a buyer hits the lifted offer, they are not merely participating. They are signaling that the current price is a secondary concern to the necessity of ownership. This aggressive participation is the true driver of price discovery. While passive liquidity acts as a brake or a cushion, delta represents the foot on the gas pedal. By analyzing the delta of a specific candle or price level, we move beyond the superficiality of total volume and begin to see the underlying force of aggression that dictates whether a level will hold firm or shatter under pressure. However, delta is not a magic bullet. It is a gauge of pressure. A high positive delta suggests a surge of buying aggression. Yet if price fails to move upward despite this heavy buying, we encounter the phenomenon of absorption, where a passive seller is absorbing every market order thrown their way. This interplay between the aggressive hitter and the passive absorber is where the most critical market turns are forged. To decode the futures market is to realize that price does not just move, it is pushed. In this chapter, we will strip away the noise of the tape to focus on how to read these imbalances, identifying the moments when one side's aggression becomes an overwhelming force that the current structure can no longer contain. Chapter 13, Absorption and Exhaustion, Reading the Turn. The transition from a trending market to a stationary one rarely occurs with a clean, cinematic snap. Instead, it is a process of attrition, a silent battle fought in the thick of the order book, where momentum collides with an immovable object. To the untrained eye, a rapid price move toward a key level looks like a show of strength, a signal that the trend is preparing to break new ground. But to the student of market mechanics, this acceleration often masks a predatory trap. This is the realm of absorption, the point where the aggressive size of the market finds itself swallowed whole by a passive participant who has decided that the current price is no longer a discount, but a limit. Imagine a high-speed train hurtling toward a station. If the engineer applies the brakes, the deceleration is visible. The momentum fades visibly as the train slows to a crawl. In the futures markets, however, absorption looks more like that same train hitting a mountain of soft sand. The engine is still roaring, the wheels are still spinning at maximum velocity, but the forward progress has stopped. On your footprint chart, this manifests as a massive surge in volume and aggressive market orders that fail to move the price even a single tick higher. The big players are sitting on the offer, absorbing every buy order the retail crowd throws at them, effectively capping the market while they build their own contrarian positions. Recognizing the turn requires you to distinguish between genuine exhaustion and this strategic absorption. Exhaustion is a lack of participation. The buyers have simply run out of breath and the auction fails because no one is left to bid. Absorption is more violent. It is the presence of an overwhelming counterforce that refuses to budge. When you see heavy, aggressive selling at the bottom of a move, yet the price refuses to break lower, you are witnessing the inventory clearing of the weak hands into the pockets of the strong. These are the moments when the trend's mechanics shift from kinetic energy to potential energy, signaling that the elastic band has been stretched to its limit and is about to snap back in the opposite direction. Chapter 14, The Value Area Crossover. Trading the shift market structure is rarely a chaotic scramble. Rather, it is a rhythmic migration from one pocket of equilibrium to the next. For the disciplined trader, the most lucrative opportunities do not exist within the heart of established value, but at the fragile perimeter where one balance zone ends and a new discovery phase begins. This is the value area crossover, the precise moment when the market's collective consensus on price ruptures, forcing a violent or methodical rotation toward a new gravitational center. To capture the meat of a move, one must stop looking for outliers and start identifying the structural shift that occurs when yesterday's fair price becomes today's rejected history. When a market trades within a value area, it is in a state of high volume agreement. Orders are filled with ease, and the auction process is efficient. However, when price begins to carve a path outside the value area high or low, and crucially retains its acceptance there, the mechanics of motion shift from rotation to expansion. This transition represents a fundamental breakdown in old logic. The crossover is not just a line on a chart being breached. It is a psychological exodus. Once the market realizes that the old value no longer holds, the move to find the next zone of liquidity is often swift, creating a vacuum that the informed trader is uniquely positioned to fill. The key to executing this setup lies in distinguishing a false breakout from a genuine structural shift. A true crossover is validated by the migration of volume. As price moves into the no man's land between established profiles, we look for the development of a new point of control. This is the market's way of anchoring itself in fresh territory. By entering the trade as the market exits the old orbit, you are essentially hitching a ride on the momentum of price discovery. You are no longer gambling on a direction. You are following the structural necessity of the market to find its new level of balance. In this chapter, we will decode the triggers that signal these transitions, allowing you to stop chasing candles and start trading the transition. Chapter 15, The Opening Drive, Setting the Daily Bias Context. The opening bell is not merely a signal to begin trade. It is a violent collision of overnight sentiment and institutional intent. In those first 30 minutes, the market digests the quiet accumulation of the London session and the pre-market positioning of the heavy hitters, translating it into a burst of raw volatility. This opening drive functions as the market's mission statement for the day. It is here that the initial balance is struck, carving out the high and low boundaries that will dictate whether the ensuing hours are a calculated march toward a distant target or a frantic, directionless churn within a consolidated range. To decode the daily bias, one must treat the opening range as a structural anchor. When the price breaks aggressively beyond this initial corridor and sustains that momentum, the mechanics of motion indicate a trend day is in play. In these scenarios, the opening drive acts as a springboard, fueled by an imbalance between buyers and sellers that refuses to be extinguished. The tape tells a story of urgency. Institutions are no longer looking for value. They are looking for liquidity at any cost. By observing whether the market holds the midpoint of this opening range, a trader can discern if the early aggression was a true commitment of capital or a mere liquidity grab designed to trap the unwary. Conversely, some of the most treacherous sessions are born from an opening drive that fails to find traction. When the price breaches the initial range, only to snap back into its center, the market is signaling a lack of conviction. These range-bound environments are often the result of mean reversion mechanics, where the daily bias is neutral and the market structure resembles a heartbeat rather than a staircase. Understanding the nuances of these first 60 minutes allows us to shift from a reactive stance to a predictive one. Before the mid-morning lull sets in, the opening drive has already provided the blueprint. Our task is simply to read the ink before it dries. Chapter 16, Mechanical Exit Strategies, Stops and Targets. The fatal flaw of the novice trader is found not in how they enter a trade, but in how they vacate it. Most market participants tether their exits to the emotional comfort of a round dollar figure or an arbitrary percentage of their account balance. This approach treats the market as an ATM with a predictable keypad, ignoring the fact that price moves through a topographical landscape of liquidity and resistance. To master the mechanics of motion, one must abandon the pain threshold stop loss and replace it with structural anchors. Your exit strategy should be a mirror image of your entry logic. If you entered because the market structure shifted, you must exit because that structure has either been fulfilled or invalidated. In the theater of futures trading, high volume nodes, HVNs, and low volume nodes, LVNs, act as the gravity and the barriers of price action. An HVN represents a zone of heavy fair value consensus, a place where the market is happy to linger and transact. Conversely, an LVN represents a void, a price level where participants have historically refused to do business, leading to rapid slippage or rejection. When setting a stop loss, the objective is to hide your order behind these structural walls. Placing a stop just past an LVN means the market must exert significant energy to break through a zone of rejection to reach you. If price penetrates that void, the why behind your trade has been structurally erased, and staying in the position is no longer a calculation. It is a hope. Profit targets, meanwhile, should be viewed as destination zones rather than price triggers. The journey of a price move often terminates at the high-volume peaks, where supply and demand reach a temporary equilibrium. By mapping out the volume profile, you can identify these HVNs as the natural parking lots for price. Aiming for the heart of the next major HVN allows you to capture the bulk of the rotational move without fighting the friction of the edges. When you align your targets with these centers of gravity, you stop trading against the trend and start trading with the inherent physics of the auction. Ultimately, mechanical exit strategies provide an emotional decoupling from the P&L ladder. When an exit is dictated by the breach of a specific volume ledge or the arrival at a known liquidity magnet, the trade becomes an exercise in professional observation rather than a gamble. You are no longer asking the market for a specific dollar amount. You are simply following the flow of the auction until it reaches its logical conclusion. By grounding your exits in the hard data of volume structure, you transform the most stressful part of the trading cycle into a disciplined execution of the mechanics of motion. Chapter 17, Intraday Dynamics, Developing Profiles and Shifts. The real-time development of a volume at price (VBP) profile is a live broadcast of the struggle between supply and demand. Unlike static end-of-day charts, intraday dynamics are fluid, constantly shifting as participants react to new information. To master the mechanics of motion, one must look past the price bars and observe how volume is distributing across the vertical scale. When we see a P-shaped profile emerging, it tells a specific story. Price has surged higher, but the bulk of the day's volume is migrating toward the top of the range. This signifies a short covering rally, where the fuel for the move is the forced liquidation of losing positions, rather than the entry of new, aggressive buyers. The P indicates that once the shorts are finished covering, the auction may lose its structural integrity, often leading to a plateau or a sharp reversal. Conversely, the B-shaped profile serves as the inverse warning sign, typically signaling long liquidation. This pattern develops when price drops and then begins to churn at the lower end of the session's range. The heavy belly of the B represents a high-volume node forming at the lows, suggesting that trapped longs are finally throwing in the towel. While a casual observer might see a cheap price ripe for a bounce, the VBP analysis reveals a market that is heavy and saturated. The accumulation of volume at these lows indicates that value is being accepted at lower levels, and the previous upward momentum has been completely neutralized by a cascade of sell orders. Identifying the transition between these shapes is the key to decoding trend exhaustion before it becomes obvious on a standard candlestick chart. A healthy trend requires the value area to move in a linear fashion, with volume distributing evenly as price discovers new ground. When the profile begins to bloat into a P or B structure, the momentum is no longer directional. It is becoming rotational. This shift signals that the market has transitioned from a trending phase into a distributive phase. By monitoring these structural shifts in real time, a trader can distinguish between a minor pullback in a strong trend and a structural collapse that warrants an immediate exit or a reversal of bias. Chapter 18, The Closing Auction. Why the end matters. The final 60 minutes of the trading day represent a fundamental shift in the market's psychological and mechanical landscape. While the opening bell is often characterized by the frantic digestion of overnight news and reactionary positioning, the closing hour, and the closing print specifically, is where the real conviction of institutional capital is revealed. This is not merely a countdown to the ringing of a bell, it is a systematic recalculation of risk. For the large-scale participant, the close is the ultimate destination, the moment when the abstract fluctuations of the day must be reconciled into a singular, definitive valuation. At the heart of this terminal volatility lies the market on close, UC order, a directive that prioritizes execution at the daily settlement price above all else. These orders represent the blind liquidity of passive funds, ETFs, and institutional rebalancing programs that are mandated to track indices with pinpoint accuracy. Because these entities must transact regardless of intraday swings, their arrival in the final minutes creates a vortex of liquidity. For the astute observer, these imbalances offer a structural decoder ring. When the buy-side mock interest dwarfs the sell-side, the market is forced into a price discovery mechanism that often defies the prevailing trend of the previous 6 hours. The resulting settlement price is the most critical coordinate on any chart. It is the official record used by clearinghouses to determine margin requirements, by fund managers to report performance, and by algorithms to set the pivot points for the following session. To understand the mechanics of motion is to recognize that the final print is not just the end of the day's journey, but the gravitational center for the day to come. When massive volume coincides with the closing auction, the market is effectively voting on where value truly lies, stripping away the noise of midday retail scalp trades and revealing the heavy-handed intent of the world's largest moving parts. Chapter 19: The Shadow of Yesterday. Inter-day relationships market memory is not a matter of sentimentality. It is a structural reality carved into the charts by the collective commitment of capital. Like a ghost that refuses to leave the room, the previous session's value remains a physical presence on the screen long after the closing bell has rung. In the world of futures, yesterday's high, low, and point of control are not just historical data points. They are the psychological anchors that dictate whether the current trade is one of acceptance or rejection. To ignore these levels is to walk through a dark room and wonder why you keep tripping over the furniture. The gravity of the previous session is most palpable within the value area. When price opens within the prior day's range, it exists in a state of equilibrium, a gravitational well where both buyers and sellers have already agreed on what constitutes fair value. Here, the point of control acts as a heavy magnetic core. Price will often drift toward it, oscillating in a low-conviction dance until a new catalyst provides the kinetic energy necessary to break the spell. Bridging the gap between two sessions requires a trader to ask a fundamental question. Is the market seeking to validate yesterday's consensus, or is it launching a coup against it? This relationship becomes a diagnostic tool for volatility. When the market gapingly escapes the shadow of yesterday's value, it signals a profound shift in perception, a breakout from the gravity of the past. However, more often than not, the previous day's boundaries act as formidable hurdles. A rally that approaches a prior value area high from below often finds its momentum sapped, as those who were trapped or sidelined the day before finally find the liquidity to exit their positions. These levels are the scars of yesterday's battles. They are the places where the most money changed hands, and therefore, they are the places where the market is most likely to pause, reflect, and decide its next move. Chapter 20: Multi-timeframe structure, context at every scale. Market structure is not a fixed architecture, but a fluid fractal phenomenon. To the untrained eye, the chaotic oscillations of a 5-minute candle and the deliberate trending of a weekly chart might seem governed by different laws, yet they are driven by the exact same engine, the auction process. Whether a trader is hunting for a 20-tick scalp or positioning for a multi-week reversal, the objective remains the discovery of value through price exploration. The internal mechanics do not change as we zoom in or out. Only the degree of noise and the magnitude of the participants' intentions shift. Understanding multi-timeframe structure is the art of recognizing that every minor fluctuation is a subcomponent of a larger narrative, a gear turning within a much grander machine. The primary challenge of navigating different scales is maintaining a sense of structural orientation. A breakout on a 1-minute chart might look like a monumental shift in momentum, but when viewed through the lens of the daily profile, it may be nothing more than a brief excursion to test the limits of a high-volume node. This is where the concept of context becomes the trader's most vital tool. By mapping the auction on multiple tiers simultaneously, we can identify when a small-scale imbalance is aligning with a large-scale objective. When the 5-minute micro-auction begins to facilitate trade in the same direction as the weekly macro-auction, the probability of a sustained move increases exponentially. We are no longer guessing at direction. We are observing a synchronization of participants across the entire spectrum of time. Scaling the auction theory requires a disciplined hierarchy of analysis. We begin with the highest relevant time frame to establish the boundary conditions, the zones where institutional long-term sellers and buyers have historically drawn a line in the sand. From there, we work downward, looking for the same patterns of balance and excess that we saw on the macro level. A swing trader might use the daily chart to identify a poor high and then drop down to the 30-minute chart to time an entry as the auction begins to repair that structural flaw. Conversely, an intraday scalper uses the higher order structure to avoid selling into the teeth of a major daily demand zone. By treating every time frame as a nested auction, we learn to trade the market as a cohesive whole rather than a series of disconnected events. Chapter 21. The Analyst's Mindset: Objectivity over Prediction. The great deception of the trading floor is the belief that a successful analyst must possess a prophetic lens. We are taught from a young age that intelligence is measured by the ability to provide answers, to foresee consequences, and to be right. However, in the realm of futures market structure, the ego's need for validation is the primary friction point between a trader and the mechanics of motion. To transition from a novice to a professional is to undergo a fundamental shift in identity, moving away from the role of a fortune teller and into the role of a risk manager. The analyst's mindset isn't built on the bedrock of certainty, but on the fluid acceptance of what is currently true, regardless of what we wish were true. The most dangerous word in a trader's vocabulary is should. When we say the market should be retreating because it has reached a specific Fibonacci extension, or that it should be finding support at a high-volume node, we are no longer observing reality. We are attempting to impose our will upon it. This creates a psychological blind spot where hope begins to masquerade as analysis. When the price action slices through our projected support level, the hopeful mind freezes, waiting for the market to correct its mistake. The objective analyst, however, recognizes that the market cannot make mistakes. It is a neutral machine reflecting the aggregate of all participant behavior. If the structure breaks, the narrative changes, and the objective mind pivot without the weight of bruised pride. True objectivity requires treating every trade as a single data point in a set of 1,000. When you view a position through the lens of a singular event, every tick against you feels like a personal affront, a challenge to your intellect. But when you zoom out to the level of probability, the outcome of any individual trade becomes irrelevant to your long-term curve. This is the mechanical decoupling of emotion from execution. It transforms the mental friction of a losing trade into mere operating overhead, much like a store owner views the cost of electricity. You aren't paying for the privilege of being right. You are paying for the opportunity to see if the current structural pattern will repeat its historical tendency. To master this shift, one must learn to embrace the discomfort of cognitive dissonance. There will be days when your fundamental bias screams that the economy is failing, while the market structure prints a clear, bullish breakout. In these moments, the analyst faces a choice: honor the internal narrative or honor the external mechanics. The market structure is the only truth that pays. Your opinion, however well-researched, is an uncollateralized liability. By stripping away the need to predict the future, you gain the clarity to react to the present. You stop looking for what is going to happen and start seeing what is actually happening, decoding the mechanics of motion without the distorting filter of expectation. Chapter 22, Constructing a Playbook, the Pre-Market Routine. The opening bell is not the beginning of the trader's day. It is the climax of an investigative process that starts in the stillness of the pre-market hours. Winning in the futures market is rarely a product of lightning-fast reflexes at the moment of execution. Instead, it is the result of a rigorous, standardized architecture built before the first tick of the regular session. Without a playbook, a trader is merely a spectator to volatility, reacting to price action rather than navigating it. A well-constructed routine transforms the chaotic data of the global marketplace into a coherent map, allowing you to identify where the high-probability battlegrounds lie before the skirmish even begins. The first pillar of this routine is the forensic assessment of the overnight session. The electronic overnight market provides a translucent preview of institutional sentiment, carving out halftime highs and lows that often serve as the day's most critical inflection points. By mapping out the volume profile and identifying where value was established during the London and Asian sessions, you begin to see the DNA of the current auction. Are we gapping out of the previous day's range, signaling a potential trend day, or are we coiled within value, suggesting a mean reverting environment? Standardizing this visual check allows you to filter out the noise and focus exclusively on the levels where the big money is likely to defend their positions. Once the technical landscape is mapped, the focus must shift to the external catalysts, the economic calendar, and volatility expectations. Trading without checking for scheduled data releases, non-farm payrolls, CPI prints, or central bank speeches is like sailing into a storm without looking at the barometer. Each release acts as a potential trapdoor or a springboard for price. By aligning these temporal milestones with your technical levels, you create a conditional framework. If the data is hot and we hold the overnight high, the target is the monthly pivot. This proactive stance prevents the paralyzing analysis paralysis that occurs when a market starts moving rapidly against an unprepared participant. Ultimately, the goal of the pre-market playbook is to achieve a state of professional indifference. By the time the market opens, you should already know what you are looking for and, more importantly, what you are ignoring. This routine is the mechanism that separates the professional from the gambler. It is the ritual of narrowing the infinite possibilities of the market down to a few high-conviction if-then scenarios. When the order flow finally accelerates at the open, you are not wondering what to do. You are simply waiting for the market to cross the lines you have already drawn in the sand. Chapter 23, False Breakouts and Traps, Avoiding the Noise. The local low is breached by a single tick, a frantic horizontal line on the screen that triggers a cascade of automated sell orders. To the uninitiated observer, this looks like a breakdown, the definitive start of a bearish trend. But within seconds, the tape accelerates in the opposite direction, vacuuming up the liquidity left behind by panicked sellers and leaving a trail of trapped shorts in its wake. Retail forums will inevitably light up with cries of market manipulation and shadowy cabals, yet what we are witnessing isn't a conspiracy. It is the cold, mechanical physics of a stop run, a necessary function of a double auction market, seeking the fuel required to move the heavy machinery of price toward its true destination. Understanding the mechanics of a false breakout requires a shift in perspective. You must stop viewing the market as a directional arrow and start seeing it as a liquidity seeker. The wash trade, or the stop hunt, are not malicious acts designed to target the individual trader. They are the market's way of clearing the decks. Large institutional players cannot simply enter a massive position at a single price point without moving the needle against themselves. They require a pocket of opposing liquidity. Thousands of sell-stop orders clustered just below a well-defined support level. By nudging price into that cluster, the market generates the sell-side volume necessary for a large buyer to fill their buy-side requirements with minimal slippage. The noise that distracts the average trader is usually the sound of these mechanical traps snapping shut. A breakout that lacks the prerequisite volume or fails to sustain a shift in the bid-ask imbalance is often nothing more than an invitation into a trap. These maneuvers serve to flush out weak hands and create an imbalance that the larger participants can exploit. To navigate these waters, one must learn to differentiate between a structural shift, where price accepts new territory, and a superficial probe designed to test the limits of exhaustion. Avoiding these pitfalls begins with recognizing that manipulation is often just a label we give to price action we don't yet understand. When price briefly violates a range, only to snap back into the value area, it is sending a clear signal about the lack of conviction at those extremes. In this chapter, we will decode the signatures of these traps, shifting your focus from the fear of being stopped out to the strategic advantage of identifying where the rest of the market is trapped. Once you understand the mechanics of the trap, you stop being the prey and start becoming the observer of the hunt. Chapter 24, the algorithmic overlay, trading with the machines. The modern futures pit is no longer a cavern of shouting men and frantic hand signals. It is a silent, air-conditioned hall of humming black boxes. Today, the mechanics of motion are driven by lines of code that process information at speeds defying human biological limits. To the uninitiated, the price action on a screen can seem erratic or even rigged, but the truth is far more structural. High-frequency trading, HFT, and sophisticated algorithms have become the dominant species in our ecosystem, acting as the primary providers of liquidity while simultaneously serving as the catalysts for sudden, violent shifts in volatility. To trade successfully today is to stop fighting the machines and to start decoding the mathematical footprints they leave behind in the order flow. These algorithms are not sentient, nor are they mystical. They are reactive protocols designed to exploit specific structural inefficiencies. When volume spikes and price breaks a key technical level, the overlay becomes visible. You are witnessing the execution of thousands of micro-decisions, hedging programs, mean reversion bots, and momentum scalpers, all firing simultaneously. They interact with volume in a feedback loop. High volume attracts the machines, and the machines, in turn, generate more volume as they battle for microscopic price advantages. This creates a dual-layered market where the underlying economic value is often obscured by the sheer velocity of programmatic turnover. Mastering the modern landscape requires a shift in perspective from "what is the price?" to "how is the liquidity moving?" The machines have a specific signature. They often create wash actions or test the edges of a trading range to sniff out hidden orders, a process that can look like noise to a traditional discretionary trader but represents vital data to the structuralist. By understanding the constraints of these algorithms, their need for deep liquidity, and their programmed aversion to certain types of tail risk, you can learn to position yourself alongside them rather than across from them. The goal is coexistence, identifying the moments when the machines are exhausted or overextended, and moving into that space with human intuition fueled by mechanical logic. Chapter 25, Mastering the Machine, Your Path Forward. To master the mechanics of motion is not to find a magic key that unlocks every door, but to understand the fundamental physics of the engine itself. Throughout these pages, we have deconstructed the market into its raw components: the combustion of volume, the friction of volatility, and the structural integrity of price levels. By viewing the futures market as a living machine rather than a chaotic storm, you have transitioned from a spectator to an operator. The framework we have built, integrating the auction process with rigorous liquidity analysis, is your schematic. It is the bridge between the theoretical movement of capital and the practical execution of a trade. The true challenge begins when the static charts of a textbook transform into the kinetic reality of a live session. Discipline, in this context, is not merely the emotional fortitude to take a loss. It is the intellectual rigor required to stick to the mechanics when the noise of the crowd grows deafening. Your path forward demands a relentless commitment to the data. You must continue to archive the behavior of volatility at key structural barriers and observe how volume reacts when price tests the boundaries of previous value areas. The machine does not stop, and neither can your study of its internal rhythms if you intend to remain synchronized with its shifts. As you close this chapter and turn toward the screen, remember that the goal of a professional operator is not to predict the future, but to react correctly to the present. The decoded structure of the market reveals the high probability paths, but it is your application of this knowledge that dictates your survival. Treat every trade as a diagnostic test of your framework. Refine your edges, respect the mechanics of momentum, and never lose sight of the fact that in the world of futures, price is only the shadow cast by the movement of liquidity. The machine is yours to navigate. Operate it with the precision it demands.